Can you buy a house with massive student loan debt? Short answer, yes. I'm Megan with Student Loan Planner, and I'm going to break it down for you on how you can buy a house with massive student loan debt. This is a question I get a lot of when I'm talking to someone who wants to purchase a home as part of their short-term goals, but they've got a very large student loan balance that's kind of hanging there on their shoulder, right? And the short answer to can I buy a house with these student loans is yes, but your approach matters. What lenders care more about is your debt to income ratio, but that might mean something different to you. You might be thinking, oh, shoot, well, my balance is huge compared to my income. That's not what they care about. They care about what your required monthly payment is in comparison to your monthly income. So there's some strategy here. So let's debunk some common fears, right? Will you ever qualify for a mortgage with student loans?
I think yes.
It depends on your student loan payment relative to your income, not just the student loan balance. The next kind of fear, knee-jerk reaction might be, should I just wait to purchase a home until my student loans are paid off? Not necessarily. That may do you a disservice if you've got a very large balance that's going to take you a long time to either pay off or get towards loan forgiveness with. Waiting too long could really mean missing out on low interest rates or just being a participant in the market of owning real estate. So that could be a big downside if you're waiting a long time until it takes you time to pay off the student loans. And think about the things that you're also doing if that's the case. If you're prioritizing the student loans, putting all of your extra income towards those, we're also not saving for a down payment, right? We do need that if we're looking at purchasing, or at least money for closing costs. We're also not saving for retirement, which is putting our long-term future in a bad position. So I think there's a balance. I think, yes, we can certainly purchase a home, even if we have student loan debt. We just have to have the right plan for all those things.
It's a balance.
So how do student loans affect the mortgage approval? Let's talk about it. DTI, or debt to income ratio, matters most. For conventional loans, lenders will use 1% of the total loan balance if they don't have a payment reported on your credit report. If you have federal student loans, this could happen if you have a $0 payment because your income last year when you applied for an income-driven plan was really low. It generated a $0 payment for you. Or it could be because you're in a forbearance due to either you pausing the payments yourself or an administrative forbearance where the Department of Education has put everybody's payments on pause, which happened definitely during COVID. We had a long payment pause during that time. And also around now when they're debating if they want to keep the SAVE plan, one of those income-driven plans. So if you don't have a payment reported on your credit report, conventional loans is going to use that 1% of total balance number. And that might be a lot compared to what your actual payment would be. So there are ways that you could go ahead and get a payment generated based on either income or based on a different payment schedule that is a lot lower than that 1% total balance number. FHA loans use 0.5% of the loan balance if no reported payment is on your credit report. So similar conversation to what we just talked about with conventional loans. There are ways that you can force a payment to kick in to show a lower payment than what the 0.5% is going to represent of your total balance. VA loans. These are generally going to be more flexible. They may exclude student loan payments if they're deferred for 12 plus months. Might want to chat with a mortgage broker about how that would play into your scenario if you're considering a VA loan. I talked a bit about income-driven repayment plans. So these are something we could use or utilize to make sure our payment is actually proportionate to our income. And that is a payment calculation that these mortgage lenders will accept because it generates a payment that will show up on your credit report. And it's based on a percentage of your income, of course, versus the total balance. So this can help a lot of folks, even if you're not planning on staying on an income-driven plan long-term, it can help your approval odds look better because your payment is a lot lower on paper than what it could be if you took a different approach with your loans later. Some different mortgage loan types for high student loan borrowers could be a physician and a professional loan.
Me, doctor.
These tend to have no PMI, which means private mortgage insurance. That's like a little fee they tack on top of your mortgage payment to basically cover the lender if you were to not pay, make right on your loan. So it's an insurance policy that they kind of take out on you to make sure that they end up getting paid the mortgage over time. Because typically why this happens is you don't put a lot of equity down. If we have a low down payment, they want some assurances that we're still going to be a good borrower and be paying this loan back. So that's what PMI is. Typically, you can avoid it if you're putting 20% down, but with a physician or a professional loan, also called like a doctor loan, you can avoid this PMI charge altogether, which is pretty nice. These loans also allow for higher debt to income ratios. They understand that for especially doctors or medical professionals, there's a period of time of training where your income is really low after graduation, but there's a big step in income once you go into residency or go into practicing. So they take that into account and they're a little more lenient on the debt to income ratio. I mentioned this before, but could also have a low or no down payment, which allows us to be able to get into property without having to save up a massive down payment, which could get you in faster. FHA loans have a low down payment requirement, a minimum floor of 3.5%, but they are stricter on debt to income ratio. VA loans, if eligible, if applicable, don't require a down payment, and they are generally more forgiving on DTI. Conventional loans are a very common loan type. They are best if you have strong credit and a decent down payment. They also have a lower payment floor. Check with the lender near you to see what that might be. How can you lower your student loan payments to improve your mortgage eligibility? Well, we can consider switching to an income-driven plan if we're not already on one, or recalculating your payment. That can help lower your debt-to-income ratio because our payment would be lower against what our monthly income is. If you're in a position where the income-driven payment is actually higher than what it might look like to just go on a fixed repayment plan, consider looking at either the standard fixed repayment plans within the federal system, which just takes your balance, spread your payments out over a specific period of time, and it's designed to pay off the balance all within that time frame. Or consider refinancing, which is where you take it to a private company. You're getting a lower interest rate ideally, and you can commit to a term that works within your budget. Cautionary note, though, on refinancing is if you take a loan to a private company, this is going to be a hard inquiry on your credit, and a mortgage lender is probably not going to like that. So before you go and refinance your student loans or privatize them where there's a hard inquiry on credit, make sure to chat with your mortgage broker first, or maybe consider doing it after you've been approved for the mortgage. How much mortgage can you even afford? This is a great question because mortgage payments and rent is not necessarily apples to apples. I would say they're an apples to orange conversation.
They're not the same.
General rule of thumb is you want to keep your housing costs, which is your mortgage, your taxes, your insurance. You want them to be below 28 to 30% of your gross income. That's a general rule of thumb. That means we're going to have other funds that we could use for groceries and for other necessities and fun too, building into our budget. We're not going to be considered house poor, where the majority of our income goes to our housing. That's a tough position to be in if you like to get out and about and do other things with your money and save for your future. There are specific DTI limits within different mortgages that you can be considering. Most lenders prefer less than 43% DTI. So that means all of your debt payments added up together. So if you have a car payment, your student loan payment, any personal loans that you have, any credit card debt that you have, add up all those payments, the required payments that you have per month, divide that against your gross income. That will get you your total DTI. That needs to be below 43%. If it's higher than 43%, we need to be looking at our debt situation a lot closer and focusing on that first. Do you really need 20% down? No, we don't have to have 20% down. 5 to 10% is typically enough. Some loans even allow you to go lower, like FHA, VA, physician's loans. They can require a lot less. One thing that financial professionals will do often is consider the opportunity cost between investing that extra cash versus putting 20% down on a property, and seeing what that opportunity cost is overall. Interest rates more recently, starting in 2020, 2021, were really low. That's not exactly the environment we're in now. We're kind of in that gray area with interest rates where it's like 5 to 7%. I say gray area because 5 to 7% is what we would hope we can get on the low end investing in the market long term. So then the question is it better to save and invest that extra cash in the market and have it grow 5 to 7% or more over time long term? Or do we want to put it on a mortgage that's charging us 5 to 7%? That decision could certainly thoroughly be talked about with your mortgage broker, with the financial professional to decide what's the right decision for you. So in summary, yes, you can buy a home with massive student loan debt, Drop a comment down below, though, to tell us what your biggest struggle is when it comes to buying a home while managing your student loans. And subscribe for more content around student loans and other financial planning topics that they inevitably touch. And I'll catch you on the next one.